What if I told you that every economic boom, every period of prosperity, every surge of jobs, growth, and wealth is already carrying within it the seeds of the next recession? Not because of bad luck or political mistakes, but because of a repeating hidden pattern. Economists rarely talk about a pattern so old, so predictable, and so deceptively simple that once you see it, you'll never look at economic good news the same way again. Today, we uncover that pattern, a cycle driven by debt, deflation, overexpansion, and a silent mathematical force that has crushed empires, collapsed financial systems, and triggered every major downturn of the last 200 years. This is the story of the hidden debt deflation pattern, and how every boom eventually becomes the trap no one sees coming. And the twist: this pattern is repeating right now. Setting the stage to understand this pattern, we travel back to the early 20th century when an economist named Irving Fisher tried to warn the world about a silent economic killer. He didn't call it a crash, he called it debt deflation. Fisher argued that economies don't collapse because people simply stop buying, they collapse because excessive borrowing during good times creates a chain reaction that later becomes impossible to escape. In his view, the boom isn't separate from the bust, it is the very cause of the bust. But no one listened. Banks were lending freely, consumers were spending fearlessly. Businesses believed the modern economy had outgrown recessions. The same optimism that powered growth was planting the seeds of destruction. Origins of the pattern. The cycle always begins in the same way, with excitement, innovation, and opportunity. A new technology, a new financial tool, a new industry, something that feels revolutionary. In the 1920s, it was automobiles and consumer credit. In the early 2000s, it was housing finance. Today, it's zero-interest borrowing, tech valuations, and corporate leverage. At first, borrowing looks harmless. A small loan, a mortgage, a credit line. But when everyone borrows and banks compete to lend, asset prices rise. People feel wealthier, and because they feel wealthier, they borrow even more. Slowly, quietly, the system becomes fragile. Here, the boom accelerates. Borrowing increases, prices rise, confidence grows. A self-reinforcing loop begins. Borrowing boosts spending, spending drives prices up, rising prices create the illusion of wealth. And this illusion encourages even more borrowing. Every major boom from the roaring 20s to the dot-com bubble to the recent crypto and property spikes follows the same psychological curve. The cycle reaches its peak when people start believing prices can't fall. Money will always be cheap, and debt is the path to wealth. That belief is the moment the system becomes most vulnerable. The breaking point. The breaking point arrives quietly. Interest rates rise slightly, borrowers struggle just a little. A few people miss payments, asset prices dip, not crash, just dip. But this small shift flips the entire equation. Borrowers suddenly need more money at the exact moment banks become cautious. Prices fall further, falling prices trigger selling, selling pushes prices even lower, lower prices destroy wealth, and that destruction triggers panic. This is the debt deflation spiral Fisher warned about. In deflation, the value of money rises, but the value of assets, salaries, and business revenues fall while debt stays the same. Debt becomes heavier. The downturn becomes inevitable. The fallout, once the spiral begins, it spreads everywhere. Banks tighten lending, companies freeze hiring, consumers stop spending, markets collapse, governments panic. Every major recession: 1929, 1973, 1987, 2001, 2008. 2020 follows this identical chain reaction. The details differ, the mechanism does not. A recession is simply the moment when there is too much debt and not enough money to service it. The boom transforms into the trap. Failed fixes. Governments and central banks try to repair the damage with rate cuts, stimulus, bailouts, liquidity injections, and money printing. These tools work in the short term but create larger problems later. Why? Because they add more debt to solve a crisis caused by too much debt. This guarantees that the same cycle will repeat, only bigger than before. Modern parallels. Today, global debt has reached an unprecedented $315 trillion, 3 times larger than the world economy. Corporate debt, government debt, and household debt are all at record highs. Interest rates globally jumped from near 0% to more than 5% in just 2 years. And the most alarming statistic of all is this: 60% of global economic growth in the last decade came not from productivity, but from borrowing. We haven't been growing richer, we've been borrowing richer. The same pattern that collapsed markets in 1929 and 2008 is unfolding again on a global scale. Final takeaways. First takeaway: every boom contains the seeds of its own collapse. When optimism turns into excessive borrowing, the cycle is already moving toward its breaking point. Second takeaway: debt deflation is mathematical, not emotional. Once prices fall and debt stays the same, the downward spiral becomes automatic. Third takeaway: we repeat the same cycle because every major crisis is fixed by adding more debt, not reducing it. Warning and call to action. We are living in the most debt-dependent global economy in human history. The next downturn, won't be a surprise, it will be the natural result of a pattern already in motion. The only question is when, and whether we will recognize the signs before it happens. If you found this analysis valuable and want more deep dive content about economic history, financial patterns, and hidden forces shaping the world, then subscribe, like the video, and share it with someone who believes today's boom will last forever. The pattern has repeated for centuries, but your awareness doesn't have to.